Yes, thanks for having me. So I'm Maggie Wang. I run global private credit and structured credit research at Citi. I've been doing this since 2007, starting my career at JP Morgan and spent the last decade at Citigroup. It's a great conference. It always has the best crowd. I think global investors love this conference because they can get a global perspective. I'm based in New York, and whenever I come, I see clients and issuers in Europe, in Asia, and US too, obviously. So it's a very good exchange platform. A few trends I'm seeing right now, and that's not just limited to Europe, but also applied to global private credit market. First of all, the market is getting bigger. So we see numbers indicating the market already is 1.7 trillion globally, and that's expected to grow to 2.8 trillion by 2028. So that's basically 50% growth in the next 4 years. So tremendous growth opportunity. And there's a lot of competition for origination right now. So we know the interest rates are running historical high, so the borrowing cost is high. And so the challenge for many players today is to originate and find the best quality loans. So, without saying, there's a lot of competition for quality assets. At the same time, you see the fundamentals have changed a bit too. So we do see a lot of funds have enjoyed a great amount of inflow and sitting on a lot of dry powder. So the willingness to deploy is high, yet at the same time, the willingness to borrow at high interest rate is relatively low. So I think it's very important to watch the underwriting standards. And we do see some loosening in underwriting, especially at large corp, part of the middle market. That's where the banks and private credit lenders compete for market share. We have not yet to see such deterioration in the lower middle market, but I think it does trickle down to some smaller companies too. So it's very important to watch the underwriting standards. And also, we see banks have been willing to provide financing to private credit funds and literally, giving themselves the position of being the senior lender to private credit market. So it's not just a competition from banks, between banks and private credit lenders, it's the partnership we're seeing as well. And that's happening in the US, Europe. So asset-based finance market is actually a larger market than direct lending. We see at probably 5 trillion addressable market globally, and Europe will be a significant portion of that. I think the challenges in the market growth, but also those huge opportunities. The challenges is that the fact that the market is more nuanced and also more complex than traditional fixed income assets. So while we see inflows coming to the market growing, there's still lack of understanding of the underlying risks and the structures and etc. While the opportunity there is again to earn equity-like returns potentially, and also be a senior lender to high quality assets. And we basically see lending at the rate at 150 to 200 pips above the broadly syndicated market, while the security, either collateral securitized or secured against lending being quite strong. That's an excellent question. So CLO has been a great financing tool for the broadly syndicated loan market. And we see, roughly speaking, in the US, for example, 70% of broadly syndicated loans financed by CLOs. While in private credit market, that ratio is only 10%, roughly speaking. So it's still a niche market, when we speak about private credit CLOs being the financing tool for private credit market. But I think CLO will be and should be an important financing tool for private credit market going forward. And private credit funds, are enjoying great inflows, and then that access probably will continue in the near term. However, if you look at the risk management and then the stability of the financing, I think CLO stands out because it provides long-term financing, and also it's rule-based, it's transparent, it can broaden the investor base for private credit funds when they look for the next financing opportunity. It's also very important to point out that we will see dispersion in performances in private credit funds, and I think we're probably gonna see higher default rate and lower recovery rate continue to play out, and then a bigger than ever dispersion in the credit performance of the funds, and that may not manifest in CLOs because CLO assets are managed by rules, and it's also a time tested market. So I do think CLO would outperform.